Hello, everyone. So we are looking at Chapter 3, Accounting Information System. So what we are going to learn in this chapter is to analyze the effect of transactions on our accounting equation, which is assets equals liability plus equity. We'll explain how the accounts, debits, and credits are used for recording these transactions. We will journalize these transactions in General Journal. We will post them and then prepare trial balances. So our accounting information system, this is a system that is used to collect and process transactions, data, and communicate that information to the end users in forms of financial statements. So the accounting information system depends on the company to company, the size of the business, the amount of data that they have to process, the complexity of that data, the information needs that they have, what kind of reports they want, and what kind of business is this? What are the transactions that they're looking at? So depending on all of these factors, the businesses determine what kind of information system they would use. Okay, so some of the examples of systems that are widely in use in the industry right now can be your QuickBooks or your SAPs. There are other ERP systems that are available. I work with one that's called Explorer. Okay, so there are different QuickBooks, Simply Accounting. So there are lots of different types of products that are available for accounting information system. The way the company chooses that, though, depends on the complexity and the information needs that they have. Right? Now, when it comes to recording the process, so the first step in our process is to analyze each of these transactions to determine what accounts will be affected. Okay. Now, we as accountants are only concerned with transactions that are economic in nature. Any transaction that is not economic, we don't worry about that as much. Okay, so we need to have some sort of a source document. Source document is usually a document that tells you there is a transaction and we need to do something about it. Okay, for example, when we purchased inventories, when those inventories are or supplies are purchased, let's say you got some pens, paper, staplers, okay, some supplies were ordered by the business. When the supplies comes in, there would be a packaging slip. That packaging slip then becomes your source document. Alternatively, you would also receive an invoice from the vendor when the supplies are delivered. That also becomes a source document. So there is always a source document attached to the transaction which tells you there is a transaction that we need to address. Once we have figured out if there will be an economic effect of these transactions, then we go ahead and refund that. So we record those transactions as journal entries in General Journal. So this is where we talk about our journal entries, debit sum accounts, credit sum accounts. We will explore that a little bit more in the further slides there. Once we have completed our journal entry, once we have debited some accounts and credited other accounts, then we take that information, or all of those journal entries are then recorded to appropriate general ledger accounts. So we prepare a T account and we post all of that information from step 2, which is your journal entries, on to step 3, which is called as the process of posting. So we take that information to T accounts. Once we post that information, then we determine the ending balances in these T accounts so that we can prepare a trial balance. And this is where we start exploring each of those. So your accounting transaction is something that is economic in nature. If there is any bearing on the economic aspect, or if there's anything to do with change in assets, liabilities, shareholders' equity, any of those financial accounts, then we take your transaction as an economic transactions. Some of those examples are these. So let's say the event is that you have purchased a computer. So is this a financial transaction? Yes, it is, because in this case, you will be receiving an asset and there will be an outflow of asset. So your equipment asset goes up, but your cash goes down. Second option, or the second scenario here, is discuss the product design with a potential customer. Now that is not an economic event. You are just discussing something. Okay. If that discussion, however, does come to fruition and it does come into a contract, or there is some financial aspect later on attached to that, at that point in time, it will become economic in nature. But as of this point in time, it is not economic because there is no impact on our asset, liability, shareholder equity. So we are not going to worry about recording this. Okay. In the third instance, we are paying rent. So when you pay rent, your rent expense goes up and your cash is going out. Your cash is an asset. So it is affecting your asset account, which means this is economic event and we will have to record that. So the first and foremost, before we jump into anything, is to determine whether your transaction is even economic in nature for us to deal with. If it is economic, that is when we go to the second step. If it's not economic, then we leave it for somebody else to figure out. So we deal with a bunch of different accounts. So when we say, in earlier chapters, when we talked about cash, accounts receivable, accounts payable, supplies, inventories, vehicles, equipment, all of those different items, they are technically accounts. Okay, so an individual accounting record of increase and decrease in a specific asset, liability, or shareholder equity item, along with opening and closing balances. So this is what your accounts look like. This is a T account representation. So there is always a title to your account. Every account should have a name. We cannot have anonymous accounts. Okay, we need to have some sort of a reference. So every account will have a name. On the left-hand side, or we also call the left-hand side as the debit side. The other side, the right-hand side, is referred to as credit side. It always is debit on the left, credit on the right. It does not change. Now, what those debits and credits mean for each account depends on the name of the account. And we will explore that concept in just a little bit here. Okay, so on the left-hand side, we have debits. On the right-hand side, we have credit. Now, when we look at the T accounts at the end will have an ending balance. So we take all of our numbers, push it to the T accounts. Depending on which side is heavier, whether your total on the debit side is heavier or the total on the credit side is heavier, your difference will sit on the heavier side. Your debits and credits work exact opposite of each other. If debit is good, then credit is bad. If credit is good, then debit is bad. Okay, so one account or one side will take the account balance up. The other side is bringing the account balance down. Okay, now which debit or credit is good for the account really depends on the account name. Right? So what we are trying to highlight here is that your debits and credits are exact opposite of each other, which means they will have opposing effect. Okay, so the net balance in your T account has to lie on the heavier side. Whether that heavier side is debit or credit, your ending balance will sit on the heavier side. So this is what our T account looks like. So we have got the total entries on the left-hand side for the debit and the total entries for the right-hand side, which is the credit. The ending balance will sit on the heavier side. If you are looking at an asset account, the normal balance for the asset is a debit. What normal balance means is every single account that we work with will have a normal balance. That normal balance could be a debit or that normal balance could be a credit. Entirely depends on which account we are looking at. So if we are considering the asset account, the normal balance for asset account is debit. which means if you keep debiting this T account, the total asset is going to go up and up and up and up. As soon as you start crediting that asset account, it will start coming down. Okay, so this normal balance concept is going to tell you whether the account balance is going up or down. So the normal balance for asset is debit. So if you throw the entries on the debit side, then your asset is going up. If you throw the entries on credit side, then the asset is coming down. When you look at your liabilities have a normal balance of credit. So if you are putting the items on the credit side of a liability account, then the account balance is going to go up for your liability. So your liabilities are going up. If you want your liabilities to come down, then we will do exact opposite of your normal balance, which is to debit those liability accounts. Likewise, with your shareholders' equity account, the normal balance for that account is a credit. So if you were to credit those accounts, the account balance will go up. If we want the account balance to come down, then we will do exact opposite of normal balance, which is to debit that account. So really, the effect of debit and credit depends on what your account name is. So track down the normal balance for the account. You always have to know what the normal balance for the account is, because that is how we will make sense of whether the account is going up or coming down, and how do we generate our journal entries. So this is the increase in shareholders' equity. Now, shareholders' equity do have different types of accounts attached to that. So there is common shares, there is retained earnings, there is revenue, there is expenses, as well as dividend. All of these accounts come under your equity section. Okay, so your common shares have a normal balance of debit. Common shares have a normal balance of credit. Your retained earnings have a normal balance of credit. Revenues have a normal balance of credit. So all of these equity accounts will have a normal balance of credit, which means the balance, as soon as you start crediting these accounts, the balance in these accounts will go up. If you want the balance to come down, then we will start debiting these accounts. Okay, so these are the transactions that will increase your shareholders' equity. If we want those shareholders' equity to be decreased, then we look at two accounts, which is the expense and the dividend accounts. So expense accounts have a normal balance of debit. Okay, but keep in mind, more the expenses, less the net income, and net income eventually flows to your equity account. Okay, so the normal balance for expense account is a debit. So if you debit those expense account, the total balance is going up. If you want the balance to come down, then we credit that. On the other side, we have the dividend account. The normal balance for a dividend account is debit. If you want to bring that down, you credit the account. Now that is a lot of information to remember and see what accounts have a normal balance of debit, what accounts have a normal balance of credit. So here is a quick and dirty tool for you. Remember DEAD for normal balances, and it's coming from your Walking Dead. Okay, I'm sure you're all aware of Walking Dead, so that's where it's coming from. So DEAD is abbreviated for debit for expenses, assets, and dividend accounts. So the normal balance is debit for any of these account types. Okay, these are categories, guys. These are not accounts. Under expenses, you could have different types of expenses: utilities expense, wages expense, interest expense, rent expense. Could be different types of expenses, but expense is a category. So for that category, the normal balance is a debit. If you were to debit any of these accounts, expenses, assets, or dividend, your total balance in the account is going to go up. If you want the balance to come down, then we will credit these accounts. All right. Okay, So if the normal balance in expense, assets, and dividend account is a debit, that means the normal balance of credit will be opposite of expenses is revenues, opposite of assets is liabilities, and opposite of dividend is your equity. Okay, so all of those opposite accounts, that is revenue, liabilities, and equity, will have a normal balance of credit. So if you were to credit any of those revenue, liability, and equity accounts, the balance in those accounts will go up as you keep crediting. If you want to bring the balance down, we will do exact opposite of normal balance, which in this case was a credit. So in order to bring it down, we will debit it. So always a good idea to look at your transaction and determine the normal balance first, then recognize whether the total balance has to go up or down, and then from there we can figure out how our journal entry should look. So this is your expanded accounting equation. So your accounting equation, as we had mentioned in the earlier lesson as well, was your assets equals liability plus shareholder equity. Primarily, this is coming from your balance sheet. If you think of your balance sheet, your assets, the total assets always have to be equal to your total liabilities plus your total shareholders' equity. So this one is just explained and expanded a little bit more. So your assets have a normal balance of debit, liabilities have a normal balance of credit, but the shareholders' equity is actually detailed. So your shareholders' equity have two main pieces, which is your shares, your common shares or your preferred shares. Then we have a retained earnings section. So the normal balance for equity account, which is your shares and retained earnings, is a credit. But if you think of the flow of information, so in the earlier chapters, when we prepared the financial statements, we said the income, the net income or loss from your income statement is going to flow through your retained earnings or changes in equity statement. From there, the numbers will flow onto your balance sheet. So this is really what this expanded equation is highlighting. It's telling you that the retained earnings is going to be impacted by revenue, expenses, as well as dividends. Now, the normal balance for revenue is a credit. The normal balance for expense account is a debit, and the normal balance for dividend account is a debit. So your debt is always going to hold true. The normal balance is debit for expenses, assets, as well as dividend accounts. Any other account will have a normal balance of credit. This is the accounting cycle. It's not a complete cycle, but this is a good start and it's the partial one. We will keep expanding that as we go move into the following chapters. But at this point in time, our first step is to analyze these transactions. As we said, we are only going to concern ourselves with anything that is financial in nature. Once we have analyzed the transaction and we know that this is financial and has some economic bearing, then we will journalize that transaction, which is your journal entry, debit some accounts and credit other account or accounts. Once that journalization process is done, then we move to step 3, which is posting to general ledger account, which is going to step 2, take all of that information or journal entries and bring that to T accounts in step 3. Once those T accounts are done, then we figure out the ending balances in these T accounts. The ending balance will lie on the side that is heavier, whether that is a debit or a credit. Once that is done, then the fourth step here is to prepare a trial balance. So we will talk about these here. So when we are analyzing the transaction, once you have determined that the transaction is financial in nature, then we move on to journalizing that transaction. Okay, so first thing that we got to look at is what are the accounts that are affected. Okay, so are my asset accounts affected? Is it a revenue? Is it an expense, liability, shareholders' equity? So what type of accounts are affected to begin with? Once you know what accounts are affected, then we recognize the normal balance in those accounts. Okay, so you have to ask yourself a couple of things when you get into analysis of transactions. Number one is, what accounts am I looking at? What accounts were affected by the transaction I'm considering? So list down all the accounts that were affected. Then the second question you got to ask yourself is my account balance going up by this transaction, or is it coming down? For example, if you are paying cash, then your cash asset is coming down. Okay, so first we determine the accounts that were affected. Second, we determine the effect on these accounts, whether these account balances are going up or down. Thirdly, we look at the normal balance for these accounts that were affected. So basically, you are marrying step 1 and step 2. Figure out the normal balance and see what do you need to do in order to increase or decrease that account. That ways we can figure out the impact of these transactions on your assets, liabilities, and shareholders' equity. So every financial transaction that we come through or account for will impact your accounting equation, which is assets equals liability plus equity. No matter what you're looking at, as soon as you say that it's a financial transaction, it always, always, always would affect your accounting equation. Your journal entry is always a double-sided journal entry. Your total of debit has to equal your total of credit. So this is your analysis of transaction. Any accounting equation will have a bearing on this accounting equation. Assets equals liability plus shareholder equity. And once again, we have shown you the details of shareholders' equity as to what will impact that account, which is your common shares and retained earnings. And retained earnings in turn, retained earnings will go up by revenues, it will come down by expenses, and it will come down by dividends that are declared and or paid. So that brings us to step 2. Once you have done your analysis to know which accounts were affected, what was the effect on the accounts, whether those accounts are going up or down, and the normal balance in that account. Once you have determined that, then we can safely move to step 2, which is to journalize those transactions. The process of journalization is you debit certain accounts and you credit certain accounts. Once your journal entry is done, your total of debit has to equal your total of credit. That is the process of journalization. Once you have journalized all of your transactions, then we move into step 3, which is posting that information to general ledgers. So general ledger contains all of your assets, liabilities, and shareholders' equity, dividend declares, revenue, and expenses. So basically, this is where we make T accounts for every account that we come across and bring those information from the journal entries into those T accounts. The process of doing the information or moving the information is called as posting. Now, the companies do have a detailed list which is of the account names, which is called as the chart of accounts. For you guys, the chart of accounts are not provided on the exams, so it's up to you to determine what the account name should be. And you should be able to figure that out with relative ease, but it depends on the amount of practice that you put in. And finally, the step 4 here is to prepare a trial balance. So trial balance, once we have completed the step 3, which is the posting, we have our T accounts ready. And as we said earlier, once your T accounts are prepared, then we will look at the ending balance in those T accounts, whether that is a debit or a credit. The ending balance will always sit on the heavier side. So once we have prepared and finalized those T accounts, then we take the ending balances in those T accounts and bring them to a trial balance. Trial balance necessarily looks like this, all that does is it gives you each of your account that was used with the ending balance coming from your step 3. So this is where we will take the ending balance in your T account, whether that was a debit or a credit. We will just bring that information forward, list those numbers in the debit or the credit column. The whole idea of trial balance is to make sure that there are no visible errors when the journal entries were posted. And one of the checks of trial balance is to make sure that your total of debit equals your total of credit. It always have to align. If your total of debit does not equal total of credit, then that indicates there is some error in your journal entry or the posting process. Somewhere in your prior steps there is an error. So it is to determine if there are any visible errors. But keep in mind, because your trial balance is in balance does not always assure you that all the work that have gone into this trial balance up until this point is accurate. Your journal entries could still be incorrect, but visibly you can't tell that. So this is, my friends, what we will be exploring in our chapter 3. So these examples will be done in class. So just to quickly summarize, this is what we have looked at in our accounting cycle for chapter 3, which is transaction analysis, journalizing, posting process, and preparing our trial balance. That, my friends, is chapter 3 for you. Thank you for listening.